Hi, good morning, everybody. Thank you so much for joining SCB 10X Second DeFi Virtual Summit. I'm Thai Panich, CIO of SCB 10X. Very excited today to have with us Robert Leshner again. Robert is the founder and CEO of Compound, an interest rate or money market DeFi protocol, one of the most well-known DeFi projects out there today, and always on the top 3 TBL lists, and currently have more than $7 billion in TBL. I always love talking to Robert. He used to be an interest rate analyst in a traditional bank, so he knows both TradFi and DeFi very well. So welcome, Robert. Really good to have you again with us.
Thanks for having me back, Ty.
Yeah. So can we start off by asking you to introduce yourself and Compound and your journey from TradFi to DeFi and your vision and goal for Compound?
Absolutely. So my name is Robert Leshner. I'm the CEO of Compound Labs. And starting in 2017, we began building the Compound protocol. Over the last 4 years, we've taken Compound, which is a series of interest rate markets for different crypto assets, from an idea into reality. And as mentioned, this journey has gone from $0 of assets now to 10 billion at times. And it's one of the first and most well-known DeFi use cases. We originally, began building Compound before we arrived at an industry that people know works. When we started Compound, most of what we were doing was proving out the basic concepts of how DeFi applications and markets can function. It's been a long journey. But I'm excited to have built Compound in the open with our community over the last few years. We've done a lot of things like transitioning from team control to community governance and decentralizing the protocol, and piloting a lot of different approaches that other DeFi protocols have been able to learn from. So distributing tokens to users, building an open governance system, and creating building blocks for the rest of the community. So the journey's been, long, especially as one of the oldest DeFi projects, but it's going to continue for the next, set of years as well. So I'm excited to continue the DeFi journey with everyone listening tonight.
No, that's great. Yeah, I have heard that now people call you the father of modern agriculture, aka you farming. That's quite funny.
I like that nickname.
So, as one of the OGs of DeFi, how do you see the landscape right now, and what can be the next trend in DeFi?
Yeah, so the landscape in my mind is that we're still relatively early. So, when we began building Compound, there wasn't even a common appreciation or understanding that you could use a smart contract to create a DeFi application. All of the prior examples of smart contracts being used to build financial products ended poorly. The DAO was hacked. The Parity multi-sig wallet was hacked multiple times. There was huge failures. And so, that's in my mind, emblematic of just how early we are. I think we're continuing to be at a phase now where we're beginning to sort of understand as a community that this can work. And it can work at scale. So an application, when it runs safely, can grow exponentially from a small amount of assets in the protocol to essentially an small scale can work at a large scale. And I think I would describe where we're at as an industry as going through this growth stage of finding the applications that are working, increasing the amount of usage and adoption of them, and then using them as a foundation, both for other applications and for other use cases, both inside of DeFi and outside of DeFi in what I would call the traditional financial markets. And so this is still a moment of huge experimentation. People are trying lots of different things, between going cross-chain or onto other blockchains, between scaling up the vertical financial stack, and experimenting with new concepts of governance and user participation in these ecosystems. DAOs themselves are getting incredibly complex and interesting for the first time. And I would say in a lot of ways, this is the golden era of experimentation. I think the lessons that are learned here are going to translate into the next era, which is going to be stable, highly scaled systems managing tens of billions into the trillions of dollars of assets over the next 5 years.
Yeah, so Robert, wanted to ask you a bit about institutional DeFi, because I think recently there are a lot of interest on institutional angle. And I guess both you and Awe recently introduced the product targeting this segment, institutional DeFi. Maybe could you talk a bit about Compound Treasury?
Yeah, absolutely. So for the last few years, DeFi really has been the playground of highly sophisticated individuals. And it's been highly sophisticated individuals who are comfortable custodying their own crypto, interacting with smart contracts, trying out new interfaces, and new ways of interacting directly with applications built on blockchains. This requires, what I call intestinal fortitude. It requires some guts. And it's really been sort of, the individuals who are willing to take the most risk and understand these systems the best that have been interacting with DeFi. And on the sidelines, you've had more cautious investors, often those with institutional capital or with LPs or customer bases that can't take the same chances. They can't use protocols as early, just from a technical risk perspective. They don't want to manage what I would call the IT risks and the complexities of custodying crypto, interacting with contracts. And so what we've seen is this last few years has really been dominated by individuals, not by institutions. But institutions are starting to become interested and passionate in this space because the markets are growing. When these were $1 million markets, there was very little interest from institutions besides from a purely academic perspective. When Compound had $5 million in it, we received very little inbound interest from institutions looking to interact with the protocol. But now that DeFi is in the tens of billions of dollars, it's a large enough market and a large enough opportunity that huge amounts of capital and new participants are excited and ready to enter the market. And they're trying to navigate the different complexities about custodying crypto, about interacting with smart contracts, about managing the IT stack and the risks and the opportunities. And as certain protocols have been around for extended periods of time, they're deemed to be stable enough or safe enough to use in a limited or risk-controlled capacity. So all of this leads to Compound Treasury, which is a tool to bring institutions into DeFi. The idea is that it abstracts away all of the complexity of the Compound protocol, mostly from a technical interaction, an IT interaction, and an interest rate volatility perspective, and offers customers a product that they're used to, which is one that's based on legal contracts, not on simply interacting with a smart contract. And so Compound Treasury offers interest rates from the Compound protocol in US dollar terms to its customers. The customers don't interact with crypto. It's dollars in and dollars out. And it sources returns from the protocol and standardizes them into a fixed 4% interest rate. And so it offers all of the benefits and utility of Compound, but with like 1% of the complexity that individual users are able to navigate, but that institutions don't necessarily want.
How big can this market be, Robert? Because I actually checked the cash in the treasury of the S&P companies, and I believe that there are $4 trillion of cash that held by these corporates. And even if we have 1%, of that coming into this space, that is $40 billion type of market size. What do you think about the market opportunity here for institutional DeFi?
So the market opportunity is absolutely massive. As you mentioned, even cash held by S&P 500 companies is $4 trillion. In terms of liquidity held outside of that, it's even an order of magnitude larger when you add up all of the liquidity available. But I think it's going to be a long journey because all of that money is being held typically in the absolute safest, absolute most boring assets, ones with an incredibly low yield, but incredibly low risks. And as the risks of using a DeFi protocol decrease, there's going to be an ever larger amount of money that wants to use it. But risk is also a function of time. So, in 2021, almost everyone listening will agree that Bitcoin is safe, that your balance won't disappear, that there's not a technical flaw in the protocol. And that's a function of the Lindy effect, or it's surviving without a flaw for an increasing amount of time. But 3 years into Bitcoin, there was still constant debate and constant analysis, though, as to whether or not Bitcoin was safe to use. And if you remember the press from that era, almost everybody was left wondering, is this, sound as a technology? Well, I think it's going to take a similar amount of time, which is about 10 years before there's a common understanding that DeFi, even from a technical perspective, is low risk. And so as time goes on, the perceived risks of DeFi will decrease, and you'll see a larger and larger amount of money willing to enter the space. So eventually, yes, there's trillions of dollars looking to use DeFi, but only as the systems are proven resilient, safe, and stable will that money enter DeFi. And we're starting to see the very earliest adopters, which are those that are understanding of the small amounts of risk that do exist, are comfortable with those risks, and are willing to use a protocol in the back end. And so eventually there will be trillions of dollars in DeFi. It's a matter of time, not whether or not it's going to enter the market.
Got it. What are the profiles of the institutions that are early adopter that you try to target for compound treasuries? Are they more like a fintech company, banks, or hedge fund, things like that?
Yeah, that's a great question. So we're starting to see the most interest from fintech companies and hedge funds, folks that understand that there is non-zero risks, but that they can understand, they can get comfortable with, they can, map and they can model. So eventually in 5 years, it'll probably be like major, products offering DeFi interest rates to their users, in a big way. But for right now, it's mostly people who are willing to put their own capital into DeFi in some fashion from their own balance sheet, at least to start. And I think eventually, all user funds and all customer funds from every financial market and product will eventually be DeFi. But we're starting to see what I would call the more nimble early adopters, which are, smaller institutions, looking at this in the millions, tens of millions range, not in the, hundreds of billions of dollars.
Got it. 4% fixed interest rate, that's very attractive. Curious, how do you guys achieve that? Because when I check on Compound, the stablecoin yield right now is around 2%. So how do you guys achieve 4% interest?
Yeah, absolutely. So right now on Compound, the interest rate for stablecoins, including the comp that's distributed to all users, it's anywhere in the range of for USD coin, it's about 3.3%. For DAI, it's about 4.1%. And these are essentially the low points of where interest rates have been in the Compound protocol. One of the things that we're doing is we're offering a fixed rate over time. And Compound has had volatile interest rates over the last few months and years. And it's a function of different market cycles and different market dynamics. So within the product, we're basically able to offer a fixed 4%, and it's backed up by the capital of Compound Labs to be able to pay that interest, regardless of whether or not the Compound protocol is paying 4% on any given day. And when demand to borrow is low, interest rates are low. And when demand to borrow is high, interest rates are high. We've seen the Compound protocol, have a volatile range of anywhere from 3 to 25% on stablecoins. And on any given quarter or annual basis, it's significantly higher than it is today. So what we anticipate, what we expect is over a market cycle to earn significantly more than 4%, but be able to pass a fixed and smooth interest rate to the customers of Compound Treasury, removing that volatility and risk from them.
Got it. What do you think about our way approach? They go completely different route, more of the KYC, AML of the institutions that going into this yield farming, in particular Aave Pro pool, and that is more like a permission pool. Do you think that something like this in the future Compound might be interested? Or do you think that it's better to be fixed rate to attract institutions to come first?
Yeah, it's a great question. So, I've always been a believer that there should be, open and permissionless markets that can be global and accessible to every application and user. And that will build the largest and most stable and most useful market. I think that, it's absolutely a valid approach to make, a market that's closed off. But I think that the ethos of decentralized finance is more aligned with open and broad markets. There's actually currently no regulations that prohibit someone from interacting with an open protocol. I think it actually goes far and beyond what's required of institutions to create a separate pool. And it's absolutely one approach to go in that route. But, I've always been an advocate that, decentralized finance is one in which you have, markets without any barriers. And I think that by focusing on open global protocols, you're going to get the best result for the users and applications and institutions that are looking for DeFi.
Got it. Okay, let's shift gear to talk about L1, L2. There are increasing number of L1, and we are in the cusp of having many L2 launching. What do you think about liquidity in the system in general? Are we going to have liquidity fragmented?
Yeah, so that's a great question. There's always going to be an increasing number of L1s. And even if there's the same number of L1s, there's going to be more and more assets issued on different blockchains. And so I think there's a constant trend where assets are going to be originated and administered on different blockchains. It used to be, you had Bitcoin and then you had everything else on Ethereum. We're starting to see you have Bitcoin, you have a ton of things on Ethereum, and you have a ton of assets on other. Trend of fragment is going to continue. There's two approaches to, DeFi and liquidity, and they're very different. So in one approach, what you do is on every single blockchain, you have liquidity. You have protocols that are deployed locally onto that blockchain and interact with the assets on that blockchain. The second approach is you have liquidity and you have applications that try to cross across blockchains and have either trading of assets on multiple blockchains or borrowing of assets from multiple different blockchains in one market and protocol. It's many different islands or one massive sea. And so there's the risk that liquidity does get fragmented in the first approach. The second approach, I think, is the direction that the ecosystem is going to head over time, where instead of having locally deployed versions of protocols like a trading DEX on every single exchange, you'll have a trading DEX that doesn't matter where assets are issued. You're going to be able to trade between any two blockchains. So I think in the short term, it absolutely looks like a fragmentation risk. I think there's going to be technology. Just like any given country like the US, you might have one asset that's traded on 13 different stock exchanges. It's the same asset, right? It's the same share of stock, but there's a ton of different venues where it's traded. But to a user, it's invisible. And I think we're going to get to that same result with blockchains, where you might have many different assets on many different blockchains, but you'll be able to execute across all of them. And as a user, you won't notice.
Yeah, and you actually have Compound Gateway too, which I think help with cross-chain, bring the asset from other chain into Ethereum. Yeah, curious, can you maybe talk about Compound Gateway a bit? How's the traction there? And I think you have Ethereum Gateway live already, but I'm curious, where do they connect to? What are the chains that this one connect to?
Yeah, thank you for bringing this up. So the Compound Labs team is building a tool called Gateway. And the idea is that you can build a compound-like market that spans Ethereum and other blockchains. So right now, Gateway supports one blockchain. It supports Ethereum. But very soon we're adding integrations into multiple other blockchains and then taking the system to production. Now, what Compound Gateway does is it takes a market like Compound. And if you've ever used Compound, it looks like a bunch of assets on a web page, and they all have interest rates, and you can borrow any of them and you can earn interest on them. And it expands this list of markets from Ethereum assets to also include assets from other blockchains. And these can be EVM chains or forks of Ethereum, like Matic or like Optimism, or whether it's L2s or L1s or bridges, or it can be entirely different chains like Solana or Polkadot or Tezos. And so it has the functionality to create one really large market of all of the different assets. And you can use any of them as collateral to borrow any other market. And the net result is you have a cross-chain borrowing architecture. And this is also a way to move assets between chains. If you have an asset on Ethereum, you can borrow an asset on Solana, as a great example. And so right now it's in a testnet phase where the only blockchain that's configured is Ethereum. But as we add additional blockchains and as the community, does the work to add starports to other blockchains, the utility of the whole system gets more and more powerful. And so, by the end of this year, we're going to have the first examples of a cross-chain borrowing market. And I think it's really exciting.
Oh, looking forward to that. Yeah, I really wanted to see that happen.
Yeah.
How about in terms of regulation? What is your view on the regulatory landscape now? do you think that as DeFi grow bigger, we will have more and more regulation? It seems so. Every day there's some talk about regulation nowadays.
Right. Every day there's, some new approach
Yeah.
or, something coming out, whether it's the ability to transact, assets at all. A few days ago, there was talk amongst, US regulators about regulating stablecoins, about, dictating what stablecoins can be used, which ones can't be used, potentially, changing requirements around how stablecoins are created. Over the last 2 days, there's been a number of actions against BlockFi, which is not a DeFi platform at all, but it's a business that interacts and creates DeFi-like accounts. I think there's a trend that as these systems get larger and larger and larger, regulators are more interested in understanding them and ensuring that customers and users are protected. Now, that being said, DeFi offers, I think, something that regulators can be extremely excited about, which is open source, transparent, blockchain-based systems that are completely fair and completely safe for users. And that's really one of the goals that all regulators share, is making sure that people don't lose money in unexpected ways. And, the biggest problem that they might have with stablecoins is that, users don't know what they do and how they work. The biggest problem they might have with BlockFi is that nobody can see inside of BlockFi. Nobody knows how it works, right? DeFi, when done correctly, offers a completely transparent and over time completely safe platform, which is something that I think every regulator, can get excited about. And so, I think there's always going to be, as these markets get larger and larger and larger, more interest in ensuring that they're safe and sound. And I think it's going to come in different ways, and it's very hard to predict. But I think that regulators will look for the systems that are most dangerous to users and, try to rein them in.
Got it. How about for Compound Treasury? Did you get any feedback from the regulators yet? How they view that?
Yeah, not yet, but we're working actually with licensed partners. So it is a regulated business. It's not, an unlicensed business. So it is actually going through more of a regulatory path to being able to offer this product. So Compound Treasury, all of the funds that move are moving in conjunction with a licensed partner.
Got it. Okay. Yeah. Since you work in the bank before, I have to ask this question about TradFi and DeFi. How do you see TradFi and DeFi can work together? Any suggestion?
Yeah, I think they're going to increasingly work together. A friend of mine has a quote where he said that fintech is looking to disrupt the front end of finance, and DeFi is looking to disrupt the back end of finance. And I think it's really true. And I think in a lot of ways, TradFi is both. It's just finance, but it's being disrupted by fintech startups and it's being disrupted by DeFi. And I think in a lot of ways, TradFi wants to work with DeFi because it makes their businesses more efficient, it makes them better, it makes them faster, it makes them safer, it makes them cheaper. And I think there's going to be really strong partnerships between DeFi and TradFi over the next months and years. And we're at a very early point. It's funny because, even 3 years ago, DeFi wasn't even a word, right? And so I would say it typically takes very long amounts of time for traditional finance companies to become comfortable with new technologies and new business models. And the fact that we're even able to have this conversation today about DeFi and TradFi working together shows just how rapidly this market is evolving and how effectively, people are starting to understand the promise and potential of DeFi much faster than they even did with the internet. It took a long time before TradFi was able to start leveraging the internet to reform their own businesses and offer new products. And so I'm actually amazed by how quickly this conversation is unfolding in a good way.
That's great. Yeah, curious, DeFi TVL so far has been around 5 to 10% of the market cap of crypto. For it to go even higher than that, what do you think need to happen? What type of user, what type of inflection point we need to have in order for that to go higher?
Yeah, that's a great question. So, I think as crypto grows, the type of assets in crypto are going to evolve. So right now, crypto market cap is dominated by Bitcoin. And then after that, you have, really strong L1s that are the majority of crypto assets. Stable coins are still relatively a small part of the entire crypto market cap, but stable coins are overwhelmingly used in DeFi. Now, I think if you look at this, you can extrapolate and assume that as more and more assets are not Bitcoin, as the sort of Bitcoin dominance goes down, not because the value of Bitcoin goes down, but because there's more and more new assets that become crypto, become issued on blockchains, you're going to see DeFi use increasing. So I think, the rise of stablecoins, including stablecoins that aren't dollar-based, but are denominated in every foreign currency, is going to have a massive effect for DeFi. I think as you start to have over time more and more, real world assets, whether it's stocks and bonds and securities or real estate or things that are tokenized, you're going to start to see DeFi go up. So I think the biggest thing that's going to power DeFi and increase it as a relative share of crypto is new crypto assets.
Got it. Okay. Yeah, recently I saw that Jack Dorsey tweeted about building DeFi on Bitcoin, and the product is going to be called TBD. Yeah, what do you think about that? DeFi on Bitcoin?
Well, I think, what they're building and how it works and what it looks like and all of that is going to be TBD. I think it's too early to say, whether or not it's going to be successful. I actually hope that they're successful because I think that the more programmability there is on Bitcoin, the more it's going to interact with DeFi on other blockchains, including Ethereum. So I'm really excited about that effort. I also think it's a huge endorsement of the idea of decentralized financial products and services in general. And I think it's a good thing for the space.
That's great. Yeah, I think while we have very little time left, any advice for the audience out there or like the DeFi builder out there?
Yeah, I would say that it's still incredibly early in DeFi. A lot of unique ideas haven't been tried yet, and a lot of products that are working can always use the brain power and passion of the community. And so if you're interested in crypto and you're interested in DeFi, it's never been a better time to become involved. And there's so much opportunity. So I would say, learn about different projects. There's always availability to participate in them, whether as a user, investor, contributor, commenter, and just, dive into it. The barriers in DeFi are very low. One of the best parts about crypto is that it's open to everybody, no matter where you are or what you're doing. And so, it's a great time to get involved. And, I'm excited to see you in the community.
Okay. All right. Yeah. Thanks so much, Robert, for being with us again this year. And hope to see you in Phuket at some point when we all could travel.
Love it. Next year.
Okay. All right. Next year. Okay. Bye, Robert.